Okay, everybody, it is me, Gregory Mannarino. Sit back and relax. A lot of stuff to cover with you this morning. This is my newest segment of Markets, a Look Ahead, and that's exactly what we're going to do. Lots of stuff going on, and we need to put this together, so we can, I guess, gain a better perspective as to what is going on here. The continuing, absolutely off the freaking Richter scale rigging of the entire market. I mean, it's out of control. Me personally, I've never seen anything like this before. No one has. This is where no man and no woman has ever gone before. Today is unique. We exist in an environment of extremes, and I'm talking about extreme distortions in the financial markets. The financial system itself has become so perverted, so toxic, so frankly, twisted because of the action of central banks that's been going on since the last meltdown. Nothing makes sense anymore. Cash is moving into places where it has no business going, coming out of things where it should be going into. And it's deliberate. Again, look, central banks control the entire global financial system. They are in full control of the entire global economic system. You see, most people have no idea of that. They believe it's our policymakers who are in control of the economy. No, nothing could be further from the truth. If the central banks control the financial system, which runs the economy, well, how could it be any other way? You understand what I'm saying? And this environment, like I just said earlier, it's just so absolutely twisted. And it's twisted for a reason, because we're leading towards a climax, which I've covered many, many times with you. An engineered implosion of this hyper bubble in debt is going to happen. And even the slightest sign of instability in the debt market, and we've been getting a lot of that lately, I've been covering it to the point of nauseum, rattles the stock market. Because again, as you are well aware of, the stock market is a derivative as to what is happening in the debt market. As a matter of fact, every single asset today, derives value in one way or the other from action here in the debt market. If the debt market is in a hyper bubble, if the debt market is completely distorted beyond anyone's wildest imaginations, well, how can anything, again, I've covered this a million times, have a real price discovery mechanism behind it? It can't. It can't. And that's why eventually it's going to happen. I mean, I am aware. I wake up this morning. Okay, let me just set the stage for you a little bit here. And, I love you guys and girls. You're amazing. And you guys send me all the crash callers. Okay, Greg, this guy's calling for a crash this week. This guy's calling for another crash who's been saying the same thing on and on and on for years and years. This month or next month. Look. But again, I get it, people. I understand that. But what I'm telling you is ignore these kind of people. I'm not saying they're wrong. We are going to get a stock market crash. Absolutely. But it's going to start in the debt market. You know that. These people, these crash callers, all they want is you to click on their videos and talk about it. And it's nonsense here. It really is. They're not helping anyone. They've been calling for the same crashes since this is the biggest bull run in the history of the world. But what they're not telling you, and because they don't understand it, is it's the debt market that's the linchpin, and you know that better than anybody else. If you follow this blog, you know what to look for. I even set up a whole thing, the MMRI, Mannarino Market Risk Indicator, free to everybody. Link in description of this video, so you can understand. It's so simple to look at. It comes up with a number. It's a little equation. Comes up with a number, and then it's color coded. You can't make a mistake. I understand looking at the 10-year yield may seem kind of like a daunting task. But look, let's put this together here. What did we just find out last week? Well, the European Central Bank said specifically that they stand ready, to re-liquefy the banks. In other words, if the banks need cash, they're going to pump cash into the banks. All right. This surprisingly isn't getting almost any airtime on the mainstream financial channels. It's just not happening. Because again, if people realized what was going on, they'd be up in arms. Oh, banks are getting bailed out yet again because they're running out of capital? Huh, interesting. Didn't we do this before? Yeah, of course we did. And here in the United States, the reason why the market did so well towards the end of the week after that statement by the European Central Bank is because it knows the Fed will do the same. You know how it works. ECB does it. The Fed follows right up behind. So made the market really happy now. What we need to see, understanding, let's put that together real quick. If you and I realize, and we don't have to guess here, this is what they're saying, ECB, European Central Bank, saying, hey, we're going to do this. We're going to give the banks all the capital they need, all right? Understanding that mechanism is going to get followed up by the Fed, makes the market all kinds of happy and giddy. Oh, yeah. Oh, more easy money. Absolutely. At the expense of everybody else because it's massively inflationary. What they won't tell you is when any central bank colluding with policymakers here to, fund this and fund that to the tune of hundreds of billions of dollars in the trillions, it's inflationary, but you can't know it. You have to think, central banks can do anything they want. They can just continue to flood the world with more debt, and there's not going to be a price to pay for it. Bullshit. You know that the answer to that better than anybody else. It's massively inflationary. Any kind of things like the Inflation Reduction Act, can't make that up, that requires billions and billions of dollars to fund, well, that's inflationary too. It has nothing to do with reducing inflation. It's about pulling cash into the now from the future to sustain the system. The system demands it, people, that debt be pulled into the now from the future, and global debt must continue to expand. So understanding this mechanism here, like I just said, European Central Bank willing to reliquefy the banks, the Fed's going to do the same thing, although they're not going to announce it. We have to give credit where credit's due. The European Central Bank has admitted they're buying all the debt across the entire Eurozone. The Fed didn't say anything, but of course they're doing the same. They have to do it. Look, central banks, as you're well aware, don't have any magical power. They can't just say something. They have to get into the market. When a central bank wants to keep rates at wherever they are, they're massively suppressed around the world at this point. They have to get into the market. They have to create currency out of thin air. Just nothing. Just add digits to a screen. And poof, they just start buying the debt. And that in itself is inflationary as well. Like, you just see how this works. Every dollar, every euro, every fiat currency created by a central bank has to get its value from somewhere. And what it does is when it's created out of thin air, it has to steal a fraction of purchasing power from every other existing bill in whatever form it is. And that is massively inflationary, but you're not allowed to know that either. You're supposed to think that central banks really want to fight inflation. You heard from Powell, the thing last week. Oh yeah, the Fed's committed to this, and they're not going to stop raising rates until they tame inflation. Bullshit. They don't care at all. They're on a mission to inflate. They're on a mission to create more inflation. Alrighty. Now, understanding that the European Central Bank and the Federal Reserve stand ready to reliquefy the banks here, no doubt about it, okay? ECB already said it. Fed didn't, but they must follow suit. Should make sense to you. What we need to witness here from the stock market, from the debt market, is stability in the debt market. Now, let's talk about that. Right now, the 10-year yield's 3.32. Just looked at it. If, in fact, we see 3.32, 3.5, 3.6, maybe even 3.4, and we see a weakening dollar, relative strength of the dollar, the Dixie weaker, the market's going to like it, okay? You have to, when you're looking at the market, okay, you can't just, nothing ever remains static. You have to look at what's happening, what this central bank is saying and or doing. What this one might be doing over here too. And then you got to take in, we got some warnings I want to talk about too. You have to take all that in as well and say, okay, what's the most likely outcome? If we realize, okay, central banks are already sending this message to the market, okay, we're going to do whatever it takes, we're going to reliquefy the banks, that should be enough to stabilize the debt market a little bit. This instability we've seen, this yo-yo action in the debt market, which is not supposed to happen, this phenomenon of global bond yields rising because the debt market is selling off. You understand? That is not something that the equity markets or the stock markets would want to see. So if in fact we can get some stabilization here in global bond yields, more specifically the 10-year yield, and a weakening of the dollar, and if crude oil decides to play here and starts getting bid up, this market's going much higher. You see, you understand the dynamics that are in play here? Central banks promising easy money. Markets saying, hold on a minute. Oh, this is a good thing. Maybe we'll see some stability here in the debt market. Stock market's going to love it. If we get a weaker dollar and we get stronger crude oil, the markets are going to love it even more. Now, with that said, I want to cover a couple of things. So Bank of America here is pointing out that last week we saw some outflows from equities, and it was cash leaving the stock market. Okay, so they're pointing at that as a sign of possible sell-off here in the stock market. Now, Deutsche Bank followed that up as well, warning that a 25% drop in U.S. stocks is possible. Okay, anything is possible, but here, they're not explaining that this whole thing could reverse to the upside if we get stability in the debt market, if the dollar weakens, if we get a little boost behind crude oil. You understand? Look, nobody understands the dynamics of this market better than you do. If you follow this blog, believe me, you know exactly what's going on, and you know how to capitalize on it. Realizing the global debt bubble is not going to stop inflating. They're going out of their way to continue to inflate it. You want to be on the opposite side of that, right? Bet against the debt. Become your own central bank. Hold hard assets, more specifically silver, my favorite asset of all time, okay? With regard to cryptocurrencies, I continue to get bombarded. I have not bought any since I told you what I needed to see. I needed to see Bitcoin stabilize at around where it is now, 21, and stay there. We dropped below that, all right? So this sets up a whole new set of dynamics. In order for me to get back into the crypto space and start buying more Bitcoin, which I want to do eventually, I need to see that 21K mark hold for a sustained period of time. I want to see what I believe is a bottom build itself. You understand? So I'll keep you all on top of that, I promise, and you'll be the first to know about it, especially if you subscribe to my free newsletter, link in the description of this video. All right, people, look, I covered a lot with you here today. A lot. You understand the dynamics in play. Easy money from the ECB stands ready to reliquify the banks if need be. Let me give you another clue here. There's another signal that this is sending to the market. If the European Central Bank is saying, okay, look, we're going to reliquify the banks, and of course the Fed is going to follow suit, it also means that they'd be willing to bail out entire industries yet again here. Tech, energy, whatever it is. Okay, so again, it's a managed market. You know this, again, better than anybody else. We have no resemblance at all of a free market nor a free market economy. It's being managed and run into the ground by central banks who are determined to wipe out, exterminate, eliminate an entire class of people here. And the 1%ers, the 2%ers are going to continue to benefit while everyone else loses. That's the way it's designed. It's how it's designed to operate, okay? And with regard to the economy, it's going to free fall faster. Inflation, much, much higher than what we're seeing. And despite the propaganda, oh, inflation's getting better. Remember, we're peaking now. That turned out not to be true. Right out of the Fed's own mouth, out of their beige book. None of it was real. They knew, let me explain this to you too. The Federal Reserve, just like you and I, because we discussed it right here, from day one, realized that none of this was going to be temporary or transitory. This is ingrained into the system. The inflationary environment we are in is being fueled by design, leading to a climax here. And that climax is what? What is it? A meltdown in that debt market, which is going to lead to a complete meltdown of the financial system on a global scale. It's going to rock the core of the earth, people. And then, of course, these same entities who brought the system to its knees by design are going to introduce a new system that they already have. Pretty obvious. I think we all understand this. All right, look, I'm out here. Long video. Comment. I want to hear from you. Please share the video. Get it out there, and I will see you in the morning. I'm looking forward to it.